Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I bring you the insider's guide to property investing. Hello, mate. Welcome back to the couch.
Thank you.
Busy week, Facebook Live?
Yeah, Facebook Live on Tuesday night. Went all right.
It did go all right, mate.
Yeah.
How bad are we at sort of looking at the camera and trying to get the questions going?
Well, how do you do it?
I don't know.
Some of these questions are really
We're not Gen Y. We don't live our lives just looking at our phones. Mate, we're Gen X. So.
Well, at the start, we didn't even know how to use them. I couldn't even bring up Facebook Live. So that's how good I'm going.
Did you notice that you got it sus quicker than me? So I had to get the Stig to help me out. So very good. Hey, so a couple of things from that Facebook Live. There was a whole bunch of questions that we didn't get to answer.
Yep.
So we're actually going to do a special recording tomorrow, Ben.
Brilliant.
And we're going to answer all the questions that we didn't get to on the Facebook Live. So folks, not only have we got an exciting episode today because we've got a very special guest, but tomorrow there will also be an extra special session to finish off the Facebook Live.
No pressure on Ibis to get all that produced and out by the weekend.
I know, isn't she going on holidays?
And she's going on holidays.
So folks, if you didn't get a chance to see Facebook Live, just go to our Facebook page, like us while you're there, and you can see the replay and listen to the tomorrow's episode. You get all of the questions answered.
You can see the camera moving everywhere, and Ibis needed to put...
But it wasn't the first 45 seconds this time, it was in the middle. You were international this week, mate. You've been headlines.
Yep. So I was on Sky News yesterday afternoon, and then I do get a little alert in terms of whether all the articles are going out for the PIPA work that I did, and we're in the UK and the US, and
mate, you've gone international.
And apparently I'm anti-apartments. So
well, mate, the last 83 episodes will prove that. But let's get straight to our very special guest. We've got Stuart Wemyss here, and I found out it's Wemyss, not Wemyss, which
Correct.
is hard to Scottish background. He's the founder of ProSolution Private Clients, and we've known Stuart for some time, Ben, haven't we?
have.
And he's one of the good guys, so it's one of the reasons why we wanted to get him on.
He's a PIPA member.
He is a PIPA member, but not only that, his business model stacks up because it's about putting the interest of the client first, and that's what. So we thought it'd be a great idea to get him on because he's going to share some insights, not only as a property investor, but he's also an investment savvy mortgage broker.
He is, and he's a great writer. He's got some excellent books out there. I always used to read his articles in API magazine and so forth. So he's one of the best. So welcome,
Stuart.
Thanks, gents. After that introduction, Eve, I'm excited to hear what I'm about to say.
Let's hope it's interesting. I say tongue in cheek because, of course, it is. You're the author of The Property Puzzle. You're the author of the Smart Borrower's Handbook. As fellow authors, mate, isn't that just an exercise in insanity, writing a book? It just takes up so much time.
It is, and I've got a meeting tomorrow, actually, with... hang on. Today's Thursday. I've got a meeting today with Leslie to talk about perhaps book number 3.
Wow.
Even though I warned everyone around me if I threaten writing about another book to bash me over the head. But anyway,
that sounds exciting. So Leslie is from Streetwise.
Major Street.
Sorry, my apologies, Leslie. Yeah. Major Street Publishing. So who's our publisher as well. So
very good. So, mate, a couple of things for you. Why property is probably the early question. What got you started professionally and personally investing in property?
I kind of fell into it, I guess. I remember the first time I thought about property and investing in property. I was working at KPMG at the time. So I went and did a Bachelor of Commerce and then did my CA, Chartered Accounting, and was working away in a firm, and just look back now thinking, what a boring job. But anyway, I was just sort of pondering investing in property. I sort of did the numbers and thought, okay, you buy a property, you borrow, this is how much the interest costs, you lose money. I just don't get it. And then the first property I bought was kind of that first home. And I was about 24, 25 and paid about $153,000 for it. It was an old sort of
money.
It was about a 1940s, 1950s 2-bedroom in Moorabbin.
Yep.
And sold it a few years later for about $300,000.
Wow.
And then the penny dropped.
There's something in this.
Yeah, that's right.
And a principal home, no tax payable.
Yeah.
Well, actually, this is straight to the bottom line.
Yeah. So that's what brought it to my attention. And then back in 2002, I was about 28 at the time, and I thought I just want to have a go at running my own business. And I had a massive dislike for commission-based financial planners. And I guess I'm tainting the whole industry with that brush, but I think the vast majority, at least in my interaction over the sort of nearly last 20 years in that space, they're quite self-serving. And that rolled me up, and I always felt like we need an asset consultant at a retail level, someone just to sit there that doesn't have a vested interest to say, okay, here's the asset classes and this is how we should divide up the money. So putting those two things together, I thought I might have a go at running my own business, and I was doing some work at Deloitte for a business that owned part of Mortgage Choice at the time. It was pre-listing. So I got to learn about the mortgage broking industry, and I thought, this is it. This is what I'm going to do.
Vehicle, similar pathway to myself.
Yeah. So on the Sunday, I came to that conclusion, a very hasty decision, walked into my partner's office, the partner I was working for at Deloitte at the time, and said, this is what I want to do. And on Friday, I packed my bags and I was out.
Wow.
So that was in May, and bonuses were paid in June. June. So I didn't even hang around for the bonus.
No, so you thought
that's conviction.
You knew exactly. Now, were you Sydney based at that time or still in
Business
Melbourne?
mistake number one. No, always been Melbourne.
Always been Melbourne.
Stick around for your bonus, folks.
Yeah, that's right.
If you're thinking of doing the same thing,
cash
just wait
flow.
60 days.
There's that cash flow thing that
What
you need.
an idiot.
Well, but you've gone on to be obviously, one of Australia's preeminent mortgage brokers. You've got an amazing business. You've got all of these great private clients that you look after. So you're not about to take on the world. You really do focus in on having deeper relationships with the clients. Tell us more about that approach.
Yeah, Seth Godin says, as soon as you want everyone, you want no one. So I guess from my perspective, it's really about if a client's fun to deal with, enjoyable to deal with, and they've got the desire to build wealth, then we're a perfect match.
Yep.
And so I guess we've got a varied client base. We've certainly got quite a lot of professionals that earn high incomes, but we've just got just as many mum and dad investors as well. So I guess, Ben, we share the same sort of ethos there in terms of there's a lot of people that need help. And it's not that difficult. Investing and making money isn't that difficult. The industry, I think, makes it a lot more, not us, but the industry as a whole makes it a lot more complex than it needs to be, because complexity creates dependency and revenue. But I don't think it needs to be that way.
Yeah, great.
I think property is simple but not easy, and I think largely it's not easy because we've got to get around our own head stuff. But the mechanics of building a portfolio of property and structuring the lending, let's be honest, it's actually quite straightforward. But it's about having someone who can guide you through that path, and also make sure you stick to the path without being susceptible to, changing wherever the breeze is going is the tough bit. So it's the upstairs. So that's why I always say it's very simple, but it's certainly not easy.
Yeah.
And I want to touch base on the financial planning comments as well. I don't know how many times I've had people come in, having a meeting with us and said, I actually went and spoke with the financial planner, but I was really underwhelmed. It was just, I felt like it was all about trying to sell me something. Ultimately, a lot of these network and dealer groups are aligned, and they've got certain types of products that they're offering and solutions around that. So, for me, this is the eye opener for that independent advice, that fee for service approach. And I think I agree that the world is moving to that. And I think financial planners, you can go and see a really great one, which I think are pretty rare as well, or you can see the run-of-the-mill one. And I say that about GPs as well. You can have a really great GP, and you can really have a shocking one as well. And you can be overwhelmed by the different messages. A lot of people go in and say, oh, this person's telling me this, person's telling me this, but this person's telling me this. So I still think it comes down to trust and having that relationship and that connection.
Most people don't find it difficult to choose their accountant, do they?
No.
And so my view is just remove the conflict of interest. If you remove the conflict of interest, then all you're left with is a client and a professional, and then the client just has to assess, does the professional have enough experience and knowledge? Do I enjoy working with them, and are they smart enough to help me solve my problems? If you pick up the paper and read the horror stories about financial planning, almost always, 99% of the time, it's because there's a conflict of interest. So I think that's, if there's one bit of advice for people out there, it's just remove the conflict.
Yeah.
And then if you feel like the person's an idiot on the other side of the table, walk away.
Yeah.
But, if you remove the conflict, typically the professionals then that are attracted to a situation like that typically have a bit of nous and knowledge.
And it's that
so
tailored
forth to
solution, isn't it? It's not that off-the-shelf solution.
No.
So it not only happens in financial services, but it also happens in the property space.
Yeah.
And obviously part of the work we do with PIPA and, is to, if there is commissions payable, and yes, some of our members do claim commissions because that has been the traditional business model for marketeers and people who do sell off stock lists. And from that point of view, that's great as long as they disclose.
Yeah.
And then the client can make an informed decision around that. Obviously you and I have gone down the fee for service path, but ultimately that's what it looks like. So I think it's a good point.
I think it's a really good tip. Remove the conflict of interest because then you feel like you're getting genuine relationship and trusted advisor status. So, very good tip. You mentioned the Moorabbin property before. Was that your first PPR? Was that?
Yes.
So, what about your first investment property? Do you remember that one?
Well, that's kind of good timing because we can discuss my mistakes and my first investment property all at once. I bought an off-the-plan property in Melbourne Road in a smaller development.
Can you add some music into that?
In Toorak, Melbourne Road, Toorak.
Yep.
So it's just near the station. It's actually,
Good
the location's not bad. Smaller development, not bad.
Yeah.
The position of the block wasn't too bad.
Yep.
But the big mistake was it was off the plan. It was mostly building value rather than land value, and it was never going to work.
Yeah.
And so I realised that, pretty quickly in the piece. Obviously, I purchased it, and then between purchasing it and settling it, I'm learning more and more about property as I'm growing my business.
Yeah.
And, by about sort of 6 months after owning it, I realised this thing's just not going to work. And I sold it. And I didn't lose any money. I probably made 60, 80 grand or something like that. So it's not a bad mistake to make, but I certainly wouldn't repeat it again.
Yeah. Well, I think the important point is it was more of a boutique one. But I think we talk about location doing 80% of the heavy lifting. But then that's not a blanket rule because Toorak's a great investment grade suburb. But if you get the property wrong, you can undo all of the good work of finding the right investment grade suburb. That's a classic illustration of that.
Yeah. It was never going to work. And it was on a main road, Melbourne Road. It's quite a busy road, even though it was at the back of the block, so the noise factor wasn't such an issue. But that was a downside to it, and then just the fact that it was mostly building value.
So you're going on this journey, you're building up your knowledge base. What are some of the sort of big light bulb moments along that journey? So what were some of the lessons around strategy and execution that you learned as you're building out that story?
Probably if I look back, been doing this 14 years now. So if I look back, what are the key lessons I've learned? And one thing I've learned I've got a mentor that's in his mid 70s, and he's run a massively successful accounting business. And it's ironic that he thinks longer term than I do, and he's in he's 70, 75, 76. I'm 41. So one of the things that I've learned to probably more particularly over the last few years is just think long term, business perspective, investing, and also in my personal life. So what can I do today so that in 20 years my life's better? I've got more money or more flexibility, more opportunity.
Ben had with me a couple of weeks ago, but someone's sitting in the shade now because they planted a seed many, many years before. And so,
I only heckle because it's a classic sort of analogy. That's all.
Yeah, but that's essentially what it is. You've got to make a decision at some point to look after what's going to happen a bit.
I think in long term reduces the anxiety created by worrying about short term market movements. And I know Chris Gray was on the podcast and said the same sort of thing. I'll buy the property in 30 years and I'll worry about it. And we actually refer our clients to Chris behind you in Sydney. So, but I 100% agree. Just think about what you can invest in today or how you can allocate your cash flow today. So that who knows what's going to happen in the next couple of years? No one really does. Let's be honest. No one's got a crystal ball. But it's a lot easier to work out what's going to work over 10, 20, 30 years.
Very true. So off the plan was one of the sort of early mistakes you mentioned before about land to asset ratio. So you learnt about that. You've learned about the long-term story. What about inner city versus outer suburban versus regional? What's some views on that? Sure.
Yeah, I mean, it's really interesting, isn't it? Certainly inner city, I think, lacks the scarcity and it has the building value issue, the land component issue that we just sort of spoke about. So that's completely out from my perspective. And I guess we can talk about our philosophies as well, but also we can. I'm speaking from experience, having done this for 14 years and seen lots of different transactions. The properties that clients have purchased before they've come to us, or post they've come to us, or if they haven't listened to our advice for the few of them, and at least we get to say there, "I told you so." Right?
They'll never ring you back. No. I don't want to hear "I told you so."
Have you found a professional way to say "I told you so"? Or is it just as blunt as that?
Just with a smile. So I've just never seen that work. Anything inner city, never seen it work. So, and outer suburbs, I guess it comes back to this quality issue, and which is kind of the second thing that I've learnt, that you can't, for better words, turn shit into gold. That at the end of the day, the quality of your assets will determine your outcomes. You can stuff everything up, the tax, the funding, everything like that. But if all you do invest in the best quality assets you can get your hands on, whether it's shares, super, property, whatever it is, you'll do well. But you can get all the other stuff right and get the asset quality wrong, it's just not going to work. As a financial planner, if you're hell-bent on investing in poor quality assets, there's just nothing I can do for you. So, the quality of your assets has to determine your outcomes. And therefore, I think if you look on a fundamental level and just look at supply and demand and scarcity, land values, all these sorts of things, the sort of outer ring suburbs around a major capital city, I think beat the outer lying areas from that perspective. And, in a rising tide, all ships rise. But so that's fine. When things are going well, everything's going up. But you've got to think about over the 30 years that you own the property, or 40, 50, whatever it is, there's going to be times where the property market's going to struggle. Well, which assets do you reckon is going to struggle more? The poorer quality ones or the better quality ones?
I reckon that's a silver lining on the GFC. I remember I lived in Queensland at the time, and I just remember using it as an exercise, probably more in hindsight reflecting than in the time, but just remembering who had the for sale signs out the front and what the quality of the stock was. Was it the C's, the B's, or the A's? And interestingly, the A's didn't have the for sale signs out the front. It was just the C's, and there was multiple sometimes in the same development, if you like. But if anything, the GFC taught me that. It's just to see when everything's, you said the rising, when everything's great, you don't know who's sort of swimming naked, but when everything's not so great, that's when we need to sort it out. Is there any, because you've seen clients for the last 14 years, what's Roadkill, horror stories, what's some of the stuff you've seen that you just sort of shake your head and go, how did that happen?
We probably share the same stories. Anything that's a fad, mining towns, positive cash flow, investing in the US, all these sorts of things that eventually run out of steam, right? Because they just don't work, so the fundamentals aren't there. But I think it's probably, most people are motivated by fear or greed, or sometimes both. And it's the greed factor that probably kills that one. So the asset test there is thinking long term. If you've got a prospect or an opportunity in front of you that was someone saying this is a great strategy, and typically it's espoused by people that have a vested interest.
It's funny.
Then it's just about sort of thinking, okay, well in 30 years I'm going to buy in a town in the middle of nowhere. I'm going to build a 4-bedroom home. I'm going to spend so much money on building value. What do you reckon this is going to do compared to, say, something that's located in Hawthorne in Melbourne? And in 30 years, where's my risk? And I think that's probably another thing too. People rush to think about return, but the richer people get, the more they think about risk first before return.
There's nothing more demoralising and heartbreaking than having someone come into your office with 3 properties that they've spent, $1.2 million on. They've got $1 million in debt against them, and the properties are now worth $500,000. It is so, because there's nothing you can do. You can't restructure one of the properties to, get the other set up. And that they're sitting on duds, and they have to ride them out because they're in negative equity. It is just heartbreaking that these people are being led down that path, especially, if they're nurses or if they're school teachers or something like that, where, they're doing a community service. In a sense, they're not going to be big income earners in the work that they do. So they're trying to offset that by building a passive income for themselves. and they've been misled.
Yeah.
And yeah, it is just absolutely heartbreaking.
It's the only thing that makes me get out of bed in the morning. Well, not the only thing that makes me get out of
Yeah,
bed.
that's at the Collingwood Football Club.
Yeah.
It's like us. I mean, I was saying to you before we came on air, and that was, we have a belief that we can help every Australian household.
Yep.
Even if it's to save $20 better than what they've been saving before. Just about those improvements in the way in which we educate them and the way in which they act with their money. And then obviously the big warnings are when you're spending $1 million on a tin shed in the middle of nowhere on some mining story, and you're thinking, great, I get $2,500 a week for the first year, and you're thinking you're a genius, and then 2 years later, that tin shed's worth $250,000 and you can't even pick up a renter. It's just horrible.
I think the answer is let other people help you, but you've got to obviously trust those people first. I think the problem is that people maybe conclude that it's too hard, they can't work it out themselves, and then they don't realise necessarily that they've been sold something. So I think there's nothing wrong. Again, another major lesson from my mentor is that professional advice is always cheap. I just paid $15,000 to my accountant to restructure the business. It's going to save a whole bunch of tax and recycle a bit of debt and those sorts of things. Now, part of my business is an accounting practice, so I could have done that work myself. But why would I? I'm outsourcing my risk. I'm learning from someone else's experience that does that sort of stuff every day. Pay for the advice, because trying to do it all yourself or trusting the wrong person will cost you 10 times more than paying for the right advice. So let other people help. I don't get it. People try and do it all themselves. And the biggest thing that I can help with a client is sharing experiences. I've got knowledge and I've done so many postgraduate qualifications that it just bores me to death. I don't really think that adds any value. The biggest value is that I've done a lot of this stuff myself before, personally, and I've seen clients I've been doing it for 14 years. I can share those experiences. You don't need to repeat the same mistakes.
Yeah, great.
Yeah, I always say it's like, I've said it a couple of times, there's two circles. One's the technical know, and the other side is the knowledge and the experience. The experience. When you merge those two and you get that sweet spot in the middle, that's the ultimate advisor right there. Because someone can theorise and someone can just be all experienced but not see the bigger picture. Someone who can merge those two things is really the goal, and that's what you said.
Yep.
And I think part of the legacy that we want to leave for our industry is to train up others. I mean, for that elite surgeon, that neurosurgeon, he's been trained by somebody, and he spent years being mentored, and so that knowledge can be passed down the chain, and that they can be great with their hands and they can understand the execution and the correct way to do this in terms of removing that tumour, whatever it is. We're the same, we're leaving a legacy in terms of, you're coaching your team of people. Obviously we've got a team of people here, and that's part of building the professionalism up in our industry as well, which is absolutely lacking, and that's, lack of regulation, doesn't see that minimum standard of knowledge. So we can get these people in, and some of these so-called sellers of these, off the plan stuff, they honestly don't know how dangerous it is.
They're enthusiastic amateurs.
Correct, enthusiastic. Great saying, Bryce. And they go and get trained by a salesman, and then they know what to sell and they know how to handle the objections. So for the listeners, I say have a healthy level of skepticism. So when you're going into a meeting, keep that radar up. But if they are answering your questions in honest, simple examples and giving the right type of explanation that makes sense to you, and they're not just, and they can get down into the substance as well as in the top level, then ultimately you've got yourself what I would think is a pretty good advisor, especially if, from our point of view, I think if they're fee for service as well, that's always a good sign as well, that they're independent. So you're selling me anything? Have you got any, you're selling me a property? No. I'm going to sit here and I'm going to do a tailored solution for your needs, and that might look different to the next person I see tomorrow or, this afternoon.
As Warren Buffett says, most advisors call competency salesmanship rather than investing. So spot on. And I 100% believe that if you're not comfortable, this is what I'd say to a client, if you're not comfortable, it doesn't make sense, don't do it. Walk away. Because nothing is that complex that it shouldn't be easy to explain, except that, the likes of some large financial services businesses, particularly in the investment space, create complexity on purpose. They can't even explain their own products sometimes of how they work.
Yeah.
And they've got different layers and different parties involved and so forth. And then it'll be sold with a tax ruling that this is okay, and all that sort of stuff just smells of smoke and mirrors, and is making money for the product manufacturer, but certainly not the end client.
Brilliant. Brilliant stuff. So you've got any other mistakes that you want to share with our listeners?
Oh, probably over-investing.
Okay.
Yeah,
great.
which is a kind of interesting one.
Yeah.
You know, sometimes I guess we probably all do it. Spend most of our time motivating a client or helping them understand why they need to take action.
Yeah.
And there's a small few clients out there that I spend a little bit of time demotivating and pulling back. And there's one client that comes to mind that had acquired an awesome portfolio of just fantastic blue chip properties and bought too many. And we said, stop, that's enough. And she'd ring up on the Monday and say, got another one? Okay.
I had one of those. Yeah. 7 in 1 year.
Oh, right, okay.
Near killed me.
Yeah.
Near killed me. I said to Rob, if you do this one more time, mate, you're going to get a new advisor.
Yeah.
Because I'm the one picking up the mess.
Yeah, that's right.
Oh, yeah.
So we've spent the last 4 years divesting of some of those assets, which is just stupid. No one makes any money by buying property and selling it within 3 or 4 years.
Yeah.
Cause a lot of stress.
Cash flow story?
Well, a bit of a cash flow problem, but thank God interest rates have been reducing over that period of time, because it could have been a whole lot worse.
Yeah.
But again, it's just about
an addiction.
And listening to advice.
Yeah.
You know,
Well, based on that, you've seen hundreds of clients over the journey. So do you see many clients come in who have a reasonable idea of actually what their goal is outside of financial freedom, I want to be wealthy, all these top line sort of generic things? Because you're saying you've got to divest because you've got too many, but a lot of people out there just are really having a peeing competition where they're saying, I've got to collect as many as I can. He who dies with the most toys wins.
Yeah.
He who dies with the most property wins.
Yeah.
But you and I both know that sometimes once you're done, you're done.
Yeah.
Just let the portfolio do the work. So long question to a short answer. To a short question. Do you see many people specifically knowing what they need?
There's 2 questions most clients, 90% of clients, can't answer. The first one is when do you want to retire and how much do you need in retirement to live the lifestyle?
Basic fundamental questions.
And then the second one is how much you're currently spending on living expenses. They're the 2.
Yep.
And it's rare that it's rare for me at least that I get a client that walks into the office that has the answer to those 2 questions. And they're pretty fundamental, aren't they? When you leave home, you jump in the car, you've got a destination, and you've probably got an idea of how you're going to get there.
Yep.
So the analogy then is, using the same analogy, is that people are jumping in the car and they're just driving around aimlessly. And then maybe they're just sitting in the car and the car's not even moving, you know. It's a bit mind-numbing.
But the traffic light's got a green light turning right, so I'll turn right, and then the next, so I'll just do whatever the obstacle gives to me rather than planning your destination.
We use the example of, I'm in Melbourne and I need to get to Darwin, but I'm not going to give you a roadmap. So you'll eventually find your way if you just keep heading north. But how efficient is that going to be, and how many mistakes and detours and reverses that you're going to make along that journey? So getting the professional advice for me is about getting the directory to know the best and most efficient way to get there. Does that mean that halfway along the journey there might be a detour because there's roadworks on, or there's something that occurs that we haven't factored in? Well, as long as we've got buffers and we're provisioned for those type of things, that's all right. We've got the spare tyre. Oh, we've had a puncture. We've got 2 spare tyres on the trip. We've got enough fuel for the journey. Just keep going. But if you're right, if everyone just just guess left here, guess right there, or have an inquisition in terms of this is where I need to be, that's where they make mistakes.
Almost nothing happens in life that you can't plan for in advance, and particularly if you're an advisor, because you're dealing with a whole bunch of different clients, all in different scenarios, all over a different life cycle. So you can, in one way, it sounds a bit arrogant. In one way, you can sit in front of a client and kind of know where the direction's going to head and some of the bumps in the road that they're going to hit, and prepare for them in advance. Whereas people, they're obviously living their life for the first time, so they don't necessarily have that.
What's in that first hour or so that you meet with them? You spend the first 10 minutes unpacking where you think they're going to go, and you spend the next 50 minutes trying to find a way to say so that they'll get it. Because the fundamentals of what you just talked about, we would absolutely agree that they're the two things that people need to be able to answer, and most people don't know how to answer. So now, if we go back to your mortgage broking sort of heritage, the transaction facilitator versus the strategist.
Yep.
Can you give us some sort of commentary around, because there's lots of transaction facilitators,
but
not so many strategists.
You know what? I wrote a vision for the mortgage broking industry about 5 years ago, and the vision was that mortgage brokers were about 42-43% of the market at that point. And my vision, and we stagnated at that point for a long period of time, probably the previous 5 years were about that level. And so I wrote a vision for the mortgage broking industry. It's actually called Broker Revolution. You can Google it, but and the idea was that we get above 50% market share, and the only way that we could or the way that I foresaw that we could do that was to really become the trusted advisor as opposed to the transaction facilitator. And I think mortgage brokers have a massive opportunity in Australia, because I think financial planners have probably done a lot of damage to their brand. Not I think, they have.
Yeah.
They've done a massive amount of damage to their brand. And many clients, we all know this, clients have a really bad impression of planners. Yep. Accountants have kind of missed the boat because they're too busy doing the compliance work, and they're not really the right type of personality.
Well, normally they're focused on the tax as well.
They're focused, and they're too short-term focused.
Yep.
You know, what's going to save tax next year? And most of their work is spending what happened last year as well.
They look at the rear vision mirror rather than through the front windscreen. And that's not a criticism, it's just industry default.
And that's what they're trained to do.
Whereas mortgage brokers, you can't sell someone a mortgage if you don't need one. You know, you're either buying a house, a home, or you've got some equity in your property, or at least then you can have a discussion about building wealth. Now, obviously, the consequence of having that discussion is maybe you'll take out another mortgage. So, of course, there's a reason for the conversation, but they don't have anything to sell you. You know, when it comes to property, there's some mortgage brokers out there that will go and link up with the developer and be very aware of those people.
Be careful.
But a really good mortgage broker will know where the separation is. For myself, I'm a financial services expert. I'm not a property expert. I know plenty about property, but I never operate in that space, and I'd refer out. Go and find yourself a good buyer's agent and so forth.
Yep.
But a mortgage broker can really occupy that role where there's very little in terms of conflict of interest, but there's a great knowledge base there and experience.
I couldn't agree with you more, and I remember writing to you once I saw you a release that you did, and I think there's a massive opportunity there for mortgage brokers to be household money managers. You know, because most of the time financial planners, there's a surplus there, great, we're going to set you up in a managed fund or whatever. So my view, and since the regulations come in where mortgage brokers are now licensed and they've got to give appropriate advice, they are in control of credit. And so they should be in control of the family budget. So a great mortgage broker should be someone who's really focusing in on cash flow and understanding that cash flow story to then take the household on a journey and to then, you know, adapt to helping the household manage their money in a more efficient way, but also then putting that surplus to work, which is really where we create wealth.
And they eat their own cooking typically. So, you know, if you've got a good mortgage broker, ask them how many investment properties they have and you'll fall off your chair. So
as opposed to that real estate agent who says, well, how many properties have you got? I'll keep selling them.
It's actually a common thing you see in our industry, particularly when you've got elite real estate agents, for example. They often don't think they're going to repeat this year, next year. So they don't feel like they want to take the risk of building the portfolio. So it's interesting that these real estate agents, because we were talking to, I had a couple of the elite agents in the office last week, and they just say, despite the fact I'm on well above average income, I just don't think I'm going to repeat it next year. And they often do, but it's just in the moment, so they don't want to take on any risk. So they're dealing with the product daily that they have seen that costs, you know, 100 grand more this year than it did 18 months ago. So they're seeing it at the coalface better than anyone, and yet they often don't walk the talk.
Yeah, crazy.
Now, I want to talk about some lessons, some of the top lessons that you've learned on your journey. So start me off. Where do you want to go?
Well, I've talked about thinking long term and asset quality and listening to advice. I think we're going to talk about procrastination, don't we? Because that's probably the last one of the top 4 issues, I guess. And you know, I find that I'll either meet clients before they start a family, you know, so that they're double income, no kids,
looking good on paper.
Probably spending more than they can, but they can wind it back. It's all discretionary. And then they might start their investment journey. But also I meet clients that might have school-age children that are getting towards the end of secondary school, and maybe they're in private schools. So they realise, hey, in a couple of years, our cash flow is going to be a whole lot better. And by the way, now we're going to start thinking about retirement. I spoke to some clients yesterday. They were late 40s, early 50s. So they're sort of 10 years away from when they're thinking about sort of winding back work. And they think, oh, well, I said, why now? It's a kind of interesting question. What's the impetus to have this conversation now? Oh, well, we just thought we'd start thinking about retirement. Really? 10 years out. Okay. So we don't understand the power of compounding growth. To try and build wealth when you're starting a family, so, if you've got young kids and so forth, it's a difficult time,
it is.
Lifestyle-wise, energy-wise, cash flow-wise, all those sorts of things. So starting before you start a family and not leaving it too late. Now, it's never too late. You've got to make a start, avoiding procrastination. And I think the answer to avoid procrastination is thinking longer term. Because speaking to people, particularly professionals that are more educated, sometimes intelligence is a hindrance. Overthink things.
Paralysis by analysis.
Some of our listeners might even relate to that.
I was guilty of that many times. There's many a property deal that I should have taken that I've overthought.
And it's really basic, simple rules of supply and demand. About quality, all the things that we've just spoken about. So I don't know what the magic tool is to wave my wand so that these people suddenly feel really comfortable to start investing. But I guess that's probably, as we get older, every year goes by quicker, faster. So, if you don't start today, before you know it, you'll blink and you'll be 10 years away from retirement and you wish you had started earlier.
It's interesting you say procrastination. When someone asks me, why should I use a buyer's agent? I say, well, you're going to pay in one of 4 ways, and it's up to you. You can choose. It's either wrong asset, procrastination, paying too much, or professional advice. It's up to you. Let me know which one it is. If you do number 4, I could probably help you with the first 3. So, last one for you, unless Ben's got one. You're about to go out this weekend, and you're about to buy a property to add to your portfolio. What are you looking for? Where are you going? What type of asset do you think that you'd want to buy?
I would buy a older style apartment. I'd buy something that is, say, built before, say, 1960s or earlier than that.
So a bit of Art Deco.
Art Deco or that sort of thing. 1 or 2 bedrooms, I wouldn't really care. Obviously well located, car parking, all those sorts of good floor plan, all those sorts of things. Because I think older style apartments are undervalued. And I know that's, because you go and look at them, I'm not saying they're cheap, because properties never really seem cheap. But I think they're a little on the nose, and I'd be really interested in your comments, both of your comments, in terms of what you think about apartments versus houses at the moment. But there's some buyers agents out there saying, look, apartments are over. Obviously, there's a sector of the market where potentially they've been sold to non-residents, and because of the change in lending and so forth, maybe that market's going to fall over. And as a result, other apartments will probably catch a cold and suffer price depreciation and so forth. But the way I look at it now is I think apartments compared to houses have quite a good run. And I'm only really talking about Melbourne here because I don't really follow other markets as closely. I think houses have a good run, but I think, if I take that 30-year time frame, to me, in the context, it looks like apartments are pretty good value.
I think you're right. I mean, the reality is that when I go into the Sydney market, and I lived in Sydney for 10 years, so I was able to get an understanding of the psychology of the buyer in Sydney. They see apartments like houses. They still see living zones and living areas as more important than the type of dwelling that they're in. And so there's an acceptance. And I've travelled in Asia quite a lot. I've probably been up to Asia maybe over 100 times in my life. So I've seen a lot of what goes on there. And it's absolutely accepted living. I've been into Hong Kong probably 15, 20 times. And so from that point of view, I do know where we're going in terms of our mega cities. Our Melbourne and Sydney being top 100 by population growth around the world, they are going to get another 1 million people in there. So I think you're right in the sense that if we take a 20, 30-year view, I have no problems with the acceptance of living closer in a high density environment. And you're in Sydney, you only have to look as soon as you land at the airport, you only have to see 30 kilometres as far as the eye can see. You've got 5 and 8 story high buildings, and they're all full. So people are accepting of them. So I think Melbourne's going to get there. I think Brisbane a little bit slower. And that's why we bought lots of properties in Brisbane.
Well,
lots of units in Brisbane.
We call them flats versus apartments because then it creates the distinction. The flats are exactly what you're talking about.
Yeah.
So we've formed the view that Brisbane is a bit like Perth, sister cities. They see it housing as the norm, but we formed a view that if we cherry pick all the blue chip suburbs, pick up the old 70s, 60s style flats where there's low body corporates, there's no concierge, there's no pool, there's no gym. The body corporates are appealing to investors and owner-occupier. And then we've got the beautiful Queenslanders next door, walking distance to everything. We've formed a view that they are going to be very scarce. So it's interesting you say that, because that price disparity between a house now in Melbourne in these 10 kilometre suburbs is starting to stretch so much that people are going to say, well, I still want to stay in South Yarra, I still want to stay in Flemington, I still want to stay close to the metropolis, but I can't afford the house now. So they're going to have to, by price point, flick their focus to re-engaging in that. But absolutely ignore apartments, but totally on board with you with the flats.
Yeah, flats. Yep.
Yeah. No, that's a good one. The other thing I wanted to add to that was the yield story is also going to be a compelling story at some point too. So if I'm going to buy a $1.8 million investment property and I'm yielding less than 2%, yet, and the difference between that 1.8 and the 1950s flat is 800,000 or 750,000, and I'm picking up a 5% yield versus that, because we're historically low interest rates, right? We're even seeing yields as low as we've ever seen them before in our lives. But if we just take a step back and take a long-term view, and we know everything will move back to 6 and 7% interest rates, and we then know that yields will probably return to their 5% levels, that's a good news story. Yep. And so, if you're in a small block of 1 to 8, or in Melbourne, we talk about what's our rule of thumb, Bryce? We've got up to 24 in Sydney. We do about 18
to 21 in Melbourne.
18 to 21 in Melbourne, and in
up to a dozen, ideally less in Brizzy, but up to a dozen in Brizzy.
Yeah, there's rough rules of thumb that we like to look at in terms of when we're seeing, because it's land to asset ratio too. So if it's on a nice parcel of land in a great location, and I've got 1/8 of that land, and I'm going to get all the benefits and the lifestyle drivers of what's there, that's going to be appealing. Yeah. And not everyone's going to necessarily be wanting family with kids.
Yeah,
so it's a really
and think about vacancy rates too. How many renters are there out there that can pay $800 to $1,000 a week in that sort of range, as opposed to $450? You're going to have a lot more. Your pool of potential renters are a lot larger.
Yeah, and that pushes that yield high, which is good.
Yeah. And final question. Have you formed a view around the fact that we've had 25 years of economic prosperity in this country? At some point, we've been telling our listeners that headwinds are actually coming for them mentally, because the long-term story in Australia is it's our country is a very ideal place politically, for a whole range of reasons. But in the next few years, they're going to be looking down the face of some hardships that they've never experienced before. But if you go rewind 20 minutes, you say play the long-term game. And we're enormously confident in the long-term perspective. What are you advising your clients when to expect the headwinds that might be coming in the next sort of 3 or 4 years?
Deutsche Bank came out with another report this week about long-term asset appreciation and so forth. But I remember reading a couple of years ago a PwC report that predicted where GDP would go to by 2050. And it was interesting, the top 4 nations produced 80% of the GDP produced by the top 10 nations. And those 4 nations were Japan, Indonesia, surprisingly, China, obviously, and India. Yep. And obviously, historically, the world production has been Europe, and then it's moved to the US, and now it's kind of moving to our region. Yes. And Bryce, as you say, it's a very investable country, Australia. So in the late 1800s, I should say, Melbourne had the highest wealth per capita. Yeah,
living standards in the world.
Yeah, in the world, because of the gold rush, and so, but we shifted it back to the UK. And so really, in a way, you could probably say potentially we're going into another gold rush sort of phase, where we've got a massive opportunity to really sort of capture that wealth and the wealth that's sort of flowing into our region. So I think I'm wary of reports and commentators that come out and say things are going to change dramatically moving forward. I mean, it happened a lot through the GFC. When the GFC hit, business over. They're not going to make money the way we used to, etc., etc. So I think you still got to stick to the time-tested fundamentals. Invest in great quality assets in an affordable way. Do it regularly. Monitor the performance of those assets and run your own race. But I think we've also, we might have some challenges with mining, unwinding, all those sorts of things, but I think we've also got some upside, particularly coming into our region, and there's plenty of money around, right? So it's really up to the individual. I don't think we can sit here and say as the economy was shrinking, so as a result, my personal wealth will shrink. Now that's crazy. There's enough property and wealth out there for the taking. You've just got to have the tools to get it.
Bernard Zoll calls it the Dubai effect, or he talks about the billionaires in Moscow live in London.
Yeah.
So it's like the billionaires in our region want to park some cash in our country. So very good. So mate, that time's flown.
It has
absolutely flown.
We're well and truly over our normal, and there's some other things that I want to unpack with you. So we've got to get you back on. I want to talk more about the two questions we said, the two biggest questions most people don't know about. When am I going to retire and how do I work out how much I need?
Yeah.
I think there's got to be an episode at some point into the future where we talk about that, because
Will you
that's
come
a
back
big
on?
part of what we
course.
do. Yeah, great.
Love to.
Fantastic.
Well, there you go, folks. As we always like to do, we like to bring people to our listener community, Ben, who can add value, give some takeaways, and I think we'd all agree that there's some really great takeaways. I'm
going to listen back to this episode. There you go. So there's some takeaways.
Wow.
I don't listen back to it.
Wow, there we go.
I'm going to listen to this one.
There you go, Stuart. You can take that as a feather.
I'll have it on high rotation at home. My kids will love it.
Put them to sleep.
Yeah, that's right.
So, folks, if you want to check out Stuart's business, we'll have it on the website, thepropertycouch.com.au, ProSolution Private Clients. All the details will be there. We'll have the details of the two books that he's written on
and where you can buy them
there as well.
Yep.
And if you go to our Facebook page, we'll have all the details and all the links there for you to check out as well. So, mate, we appreciate your time.
Yeah,
we appreciate your insights. Now, this is the point. I don't know if you've listened to many of our episodes before. Have you?
I listened to a part of the one before I came here this morning.
Well, you probably didn't.
Don't be silly. It's simple because you know what you know.
Yeah.
What do you know?
But this is the bit where we drop the credibility stakes really low.
Yeah.
Because
if we haven't already.
Well,
can you speak Scottish Gaelic? Given that you're
Scottish.
Only after 2 bottles of wine.
Five us quick. Let's get some wine.
Oh my God! What have I just put myself under? There is absolutely no way known I can do any of those.
Time to go, mate.
Seriously.
Yeah.
I'll see you again. I'll see if I can do this. So, Chima Resistu.
Mate, where's the Scottish overtone in that?
Chima Resistu.
Oh well.
Chima Resistu.
My brother-in-law is Scottish, so I'll get him to listen to that sign off and see if that was actually what I was meant to say. But again, we appreciate that Stuart's come on, shared his wisdom, and we'll definitely get him on again because there's a few more questions. But mate, thanks again.
Thanks, guys.
And until next week, Ben.
See you later.
See you, folks.